Good morning and welcome to Market Day Report. I'm Chris Swift. We have seen a little bit of action in the grain markets overnight, but it was very thin and very small. So let's take a look and see how we're going to start this morning. Got the May corn down 3/4 at $4.40 on there. It looks like about a 3-cent range is all we can pull out of it. The July contract down 1.5 at $4.52.5. December still hugging above $4.70 at $4.75 down 1.5. Soybeans have been really volatile. They've had a lot of price range over the last couple of days. They're all holding on to that 12 handle, and even November at 11.96 is pretty close to it. But the May contract at 12.01 down 10 3/4. July down 10.5 at 12.15 and those new crop November 11.96 down 8.25, and they have been back above 12 at some point in time overnight. Let's see what Chicago wheat. A little bit softer, not much. I got May at 5.45 down 1.5. New crop July 5.60 down 1.5. Hard red winter wheat. A little bit softer, not by much, down 1.5 on the May at 5.80 New crop July 5.74 down 3/4. And spring wheat. Minneapolis getting a little rain up there. May up 1 3/4 at 6.58 The July is 6.64 up 2 3/4. December new crop 6.87 up 3.5. And we'll take a look at our cotton market here. Cotton's up 34 on the May at 92.55. New crop December up 2 ticks at 83.94. I did see it broke over 84 at 84.08 as the high for the day. Bring in Brian Hoops this morning. Brian's with Midwest Market Solutions. And Brian, it's Friday. What are you doing? You got a $1 rally in beans. You got a 30-cent rally in corn. Tell me what you're doing this morning.
Well, good morning, Chris. Hey, a lot of people are talking about that dollar rally in soybeans, and I thought we saw some selling yesterday by the farmer. It seemed to increase quite a bit of sales as we got above the $12 mark once again, and we're struggling to hold that area this morning. So that was kind of a trigger point, I think, for a lot of people out there, maybe holding some old crop and wanting to move some of that. That was the key area, and we absorbed some of that selling. Now we're down again overnight as weather models are drying out parts of Argentina and adding rain into Brazil. And so there just really isn't that crop threat there for the soybean crop. The Buenos Aires grain exchange overnight left soybean yield potential unchanged for Argentina, but they actually lowered the corn potential down by 1.5 million tons because of the dry weather. That crop is still growing, still maturing, and it looks like there could be some yield loss because of the dry weather. So corn, probably has a little bit more of a bullish fundamental story, but that safrinha crop in northern Brazil at one time that was dry has now received a lot of rain. Forecast for more rain. It's taken away that upward mobility for the corn crop. So yeah, if you're a producer who's sitting on some product and hoping for South American weather issues, there really isn't a major issue on the horizon. You're looking at what happens next week in that quarterly stocks planning intentions report, and you're also looking ahead to U.S. weather. So you're getting close to a time frame where when you get those planters out of the shed, start doing some field work, it's time to start looking at new crop hedges. And if you're holding old crop, it's time to look at some of that old crop as well.
Absolutely. So I noticed when we got the 1st of March, I know a lot of HCAs hedged to arrives. A lot of cash merchandising was done the very 1st of March, and then the futures expired, prompting even more on that. That seemingly gave the market a little bit of relief. Farmers had marketed some inventory whether they wanted to or not, liked the price or not. They had gotten some action done. And is that kind of the reason why we're now not just keep driving lower and lower?
Yeah, like you said, you had a lot of cash movement around that first of the month, and a lot of that was tied to basis contracts, and farmers were happy with the basis, but not with the futures. So they actually came in and bought some of those contracts back, either futures or options, and that helped to spur us and move us higher. Now, what the CME is doing this afternoon is probably not going to help us out. They're raising margins for those corn futures and soybean oil futures as of tonight's close. And so what that does, if you think about if you're a huge fund trader and you've got thousands and thousands of contracts, now you have more money tied up in those contracts. You may have to reallocate some of those positions. That means sell some of those contracts, get a little bit smaller. Same thing for maybe your clients out there, smaller farmers. You have some of these contracts, your broker may be asking you for a little bit more margin money, and if that's the case, do you want to put that money in, or are you going to maybe sell half your position or some positions take some profits. So it could end up hurting us by the close of the bell today, just that reallocating of positions.
And just the sheer amount of money that it is taking now. I had somebody make a recognition that, a load of cattle now is the same price as a load of corn. It's really interesting to see how much money it takes. And when we do have to start meeting margin calls to be able to hold on to those marketing plans that we've done, it really does take quite a bit. Is there anything that you do to help your clients with that?
Yeah, if you want to kind of eliminate those margin calls, options are a way to go. You can buy calls and maybe sell a call as a spread that gets your option cost even cheaper. So there's different ways you can approach that rather than just holding the futures contracts. A lot of these fund managers maybe will do a combination where they're long contracts and buy some put options or sell some calls as a way to kind of manage some of that risk. So there's a lot of different strategies for producers out there. And if you're one of those who are looking at a dollar rally in soybeans, that 30-40 cent rally in corn, and now making cash sales, hey, good for you. Now maybe you want to look at some reownership strategies as far as those futures and options we were talking about.
Very good. Brian, certainly do appreciate that. Stick with me. We're going to go away and take a real quick commercial break. We're going to come back and talk with Brian Hoops about the cattle market. Stay with us. Welcome back to Market Day Report. Let's take a look at our livestock and see where we're going to start out this morning. Yesterday's closes was kind of mixed, with the April contract up 57 at 188.37. The June was down 27 at 184.50. And the Dees was down 47 at 190.15. I saw the boxes trade yesterday afternoon at 313.73, so still creeping right up in that box price. Feeder cattle market was mixed as well, with the March at 250.87. Yesterday's feeder cattle index reading was 251.82. The April contract down 30 at 254.62. That September, still can't hold that 270 handle. 269.55, down $1.05. And the hog market was pretty soft yesterday, down 40 on the April. The June contract down 132 at 99.30, so we lost that par handle on it. July at 101.90, down $1.42. We invite Brian Hoops back in again. Brian, we got a cattle on feed report coming out this afternoon. Do you happen to have the estimates with you right offhand?
Yes, we do have that report. That's 2 o'clock Central Time when the USDA releases it. So trade is looking for estimates on the on-feed supplies at about 100.9%, so almost on par with last year. Tells us supplies, as they were last year at this time, going to be fairly tight. In fact, we saw cash trade developing yesterday at on a dress basis anyway, about $4 higher than a week ago, 302. And we've heard some reports from clients in Nebraska that in a 2-3 week period, those bids are out to 306. So they're trying to get that cattle purchased already, which tells you that there's some demand, probably trying to fill some coolers up, get ready for the summer grilling season. They're willing to pay up for that cash markets. The placements number is the one that's a little concerning, about 105.9%. Some estimates may be up in the 106 range. So significantly more cattle than what we saw a year ago, and that's a real concern for the market. So we saw a lot of spread trade yesterday. April gained against the other months. You may see that type of trade again today. April gaining against some of these other contract months until that report has been released. And then the marketings, we did have a leap year in February, a leap year day, so an extra marketing day, and we saw estimates to be about 103.8%. So we're looking at decent marketing effort, and that's good, despite the fact that steer weights are on the rise and we're 22 pounds heavier than a year ago.
Wow, that's a lot of beef out there. And that's one thing that I have noticed, even though we continually see that graph where we see the cow herd going down from, I think it was 1975 to present, but yet we don't ever take a look at that beef chart and say, oh, it's just the opposite. It's right up at the tip top of what we have for beef production for the amount of cattle. So really interesting how they are able to put more beef on those cattle. So, Brian, really do appreciate you taking the time to be with us this morning.
Anytime.
That is Brian Hoops. He is with Midwest Market Solutions. And Suzanne, good morning.
Happy Friday.
It's a gorgeous spring day out there. The cherry trees are blooming right outside
this
the
guy
studio
out there.
there.
You're taking pictures. We're all walking in. Where's the coffee? And he's smiling away. That's great. Just always great energy. Chris, thank you so much.